Deciding between an ETF and an index mutual fund comes down to understanding two things: how they're alike and how they're different. ETFs and index mutual funds share many features. In fact, at Vanguard, they have the same ingredients: the same underlying index fund, the same holdings, the same investment risks. So if they're so much alike, how do you decide between the two? Start by asking yourself how you like to buy and sell. Do you want a simple way to buy and sell? Or do you want to have more control? Buying and selling a Vanguard mutual fund, which requires a mutual fund account, is straightforward. Your price is determined once a day, and you receive the fund's net asset value, which is determined after the financial markets close. Your trade settles the next day. And if you like to invest regularly, you can take advantage of our automatic investment service to schedule transfers from your bank to your mutual fund account. With ETFs, you have more say over the timing and the price of your trade. You can buy and sell when the market is open. You can get the next available market price, which may be more or less than net asset value, or you can set a buy or sell price limit. Your trade takes 3 days to settle. To buy and sell ETFs, you'll need a brokerage account, and at Vanguard, that has a $3,000 minimum. The second important difference to consider is cost. Both ETFs and mutual funds have expense ratios. That's the percentage of a fund's assets, your money, used to pay annual fund expenses. Vanguard has among the lowest expense ratios in the industry. You may be able to cut costs even further depending on the fund share class you pick: ETF, Admiral, or investor shares. Our ETFs have lower expense ratios than our investor mutual fund shares, but they have about the same expense ratios as our Admiral mutual fund shares. And now a word about transaction costs. You pay no commissions on Vanguard mutual funds. At Vanguard Brokerage Services, you pay no commissions to buy or sell our ETFs. With ETFs, you have what's known as a bid-ask spread that's built into the market price. The bid-ask spread is the difference between what a dealer is willing to pay for a security and what that same dealer is willing to sell it for. If you trade frequently, this spread could erode the ETF's expense advantage. So deciding between ETFs and index mutual funds can actually be pretty simple if you know how you like to trade and understand the costs and risks involved. For more information about Vanguard funds, visit Vanguard.com or call 800-662-2739 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. Vanguard ETFs are not redeemable with an applicant fund other than in creation unit aggregations. Instead, investors must buy or sell Vanguard ETF shares in the secondary market with the assistance of a stockbroker. In doing so, the investor may incur brokerage commissions and may pay more than net asset value when buying and receive less than net asset value when selling. Copyright 2010, The Vanguard Group, Incorporated. All rights reserved. Vanguard Marketing Corporation, Distributor.